one, I think, sort of superficial way that people look at a situation like this is, yes, Markel is much better than other insurance companies, but it trades at a premium, which is true, but it's not the end of the story, because it's not just better; it's a whole lot. But you're taking what is a mediocre investment in the average insurance company, one that you wouldn't want to own. You wouldn't really want to own. There would have to be some special circumstances in which you would want to own it. Otherwise, you wouldn't really want to own it. And then you're comparing that to one of the great compounding track records in American business. And so it's not as simple as an insurance company trades at book value, Markel trades at 1.2 times book value, and so you're indifferent. I think that you have to look at Markel's valuation like you would any other company, which is you can look at it on a free cash flow basis. And people don't look at it like that because well, insurance companies, people anchor on book value a lot, so they want to value Markel on book value. And also, Markel's earnings are so lumpy that it's hard to sort of say this is what normalized is, and this is the multiple it deserves. But historically, I was going to say Amazon, Markel has earned a high teens over a long period of time return on equity. And let's just say that 15% is the normalized return on equity. So if it trades at book value and it's 15% return on equity, it's trading at 7 times free cash flow. Right? If it trades at 1.2 times book value, it trades at 8 times free cash flow. So that's pretty good. Now you can look at it on book value too. And I think that net investments per share is a good way to look at things. So Markel has an investment portfolio which is working on behalf of the shareholders, and that is funded by the shareholders' equity and some debt and the float. And if you add up the investment portfolio, then you subtract the debt. So you're looking at the net investments per share that are working on behalf of the shareholders. You get 2.4 times book value. And there's a very strong argument that that's what it's worth, because when you buy a share of Markel, you have all those securities and investments working on your behalf. So historically, Markel is traded at 2 times book value on average. It's been actually pretty rare that it's traded as low as it has today. And I think that over time, so first of all, I think you're getting it at a great price, no matter how you look at it, on a free cash flow basis, relative to net investments per share, and relative to the historical trading range. Over time, I think what you're going to get is you're going to get very nice compounding, and you're going to get some sort of multiple expansion, because right now, the industry and Markel are trading at low multiples because we're in the midst of a very protracted soft market in insurance, which means pricing is soft. People aren't earning economic returns, and it's unsustainable. There's actually a lot of signs it's turning right now, but that's very unpredictable. But it eventually will turn. It has to, because otherwise the industry will run out of capital, and then it will turn for that reason. And so when that happens, it will be a fundamental uplift to Markel, and you'll have higher than average compounding, and then at the same time you'll have multiple expansion. The multiple could double from 1.2. That has happened before. And so when you look at a 5 or 10 year prospective return from the stock, it's extremely attractive.